You're with us here on a fresh new edition of Bazaar Morning Call. I am Prashant Nair. With me, my colleagues Nigel and Reema. Good morning, guys.
Good morning.
I mean, one just hopes that it is a relatively good morning because it cannot be a great morning, right? I mean, the SGX is indicating... Doesn't look like that. The SGX is indicating a lower start once again. We've got, what, a 100-point cut. And I might add, if we get away with a 100-odd point cut, that'll be absolutely great news, fantastic news. And it's quite remarkable. The S&P 500 is down about 16.5% for the year. And we are still above the 16,000 mark on the Nifty here. So resilience is the sort of word of the day, the word of the year so far. That's the close, by the way. The Nasdaq and the S&P 500 down about 4.25% and about 3.25% in the Nasdaq and the S&P 500 respectively. I'll just quickly run through, I mean, you know, what happened. So you had Treasury yields which all sold off, right? So the 5-year was down, the 10-year was down. The 10-year got to 3.2. It's cooled off to about 3.03. It closed. Real yields remained quite elevated. And I'll come to that in a little bit. Continued US dollar outperformance, especially against commodity-related forex. And the reason for that is because commodities came off. Oil prices were down about 6-odd%. US natural gas prices sold off 7%. Second day of a sharp sell-off there. And consider this, market pricing of what the Fed will do for the full year 2022 is actually being pulled back from almost 250 basis points and 196 on Friday. It's at 186 basis points. So what is the market worried about? I mean, the market is telling you we expect the Fed to do less as compared to what we expected it to do the week before. And the market is selling off. It's readjusting to a world without Fed support. That's point number one. Point number two, you know, irrespective of whether it's 250 or 200 or 150, the fact is that, you know, it's the Fed is committed to reducing the size of its balance sheet and increasing interest rates. So the fear is that central banks and the Fed particularly is tightening financial conditions even as we are starting to see the first hints of growth slowing. I mean, actually, it's very clear in some parts of the world. Europe, I mean, guest after guest has been coming on and saying that maybe they're already in a recessionary environment. Chinese growth is slowing down, which is a big engine for commodities and general emerging market growth. US, maybe the first signs that things are starting to cool off a little bit. So that's the big worry, tightening even as growth is starting to slow. Short-term dynamics, and this is, you know, quite difficult to decipher. There is high volatility. You look at, you know, both implied and realized volatility across asset classes, equities, rates, commodities. Volatility is very high. What it does is it reduces liquidity, and when there is low liquidity, it leads to exaggerated price moves, deleveraging. And I think some of this is playing out. It's like a feedback loop. A bounce is due. The question is whether a firm and durable market bottom is nearby. That's the point. So for us, for example, the recent March low was about 15,800 or so. Maybe we get to that and then we see a bounce, or maybe we see a bounce before that. But the fact is that for much of the year, unless something dramatically changes, it's going to be a little bumpy, a little rocky. What could change immediately? I just want to highlight three things. Policy intervention, because markets are selling off. We've seen this before. Unlikely for now, because the Fed particularly is committed that this is what we will do. So, I mean, the market throwing a tantrum, if it's about credibility now, so it's unlikely. Exhaustion, right? And that very well could be, maybe there is a catalyst. For example, we have the CPI numbers in the US on Wednesday. If that cools off a little bit, you just need sometimes a catalyst for, you know, market slide or market slide to reverse or halt at least. Third is, of course, end of outflows. This is the big one, which we will track here in India more than anywhere else. So there is a fair bit to track. For now, as I said right at the top, if we get away with a 100-odd point cut like we did yesterday, I think that's not a bad outcome at all. Guys.
Well, morning Prashant, morning Reema. Let's start off with the outflows then. You know, the FIs, we're getting used to this 40,000 crores per month outflows. And that's what's happened for all the 4 months of 2022 so far. And yesterday we got, you know, $500 million or, you know, that's become pretty much normal now, 3,500 crores or thereabouts. But what are the FIs doing in the F&O market? That's quite interesting. Yet again, they went ahead and they added shorts. Close to around 13,000 short contracts is what they added. And if you're looking at a ratio, 3 shorts for every 1 long position that's been added. Now, in terms of the positioning, short positioning now is at around 77%. You know, Prashant, in cricket analogy, if you were, you know, had to put it that way, the bowler's coming in, trying to bowl a Yorker. there are two things that will happen. Either the stumps are going to get rattled and he's going to get clean bowled. That means that we go down to around that, 16,000 odd mark or thereabouts. Or the second thing that can happen is he mistimes it and it gets smashed out of the, out of the park. So this morning as well, the SGX is suggesting we're going to be starting off with a sharp downtick. Now, let's see whether or not that is successful, because a 100-point downtick is already what we're bracing ourselves for. But what's giving me a little bit of optimism is that the put writing. Yesterday, they wrote puts. The FIs wrote close to around 30,000 put contracts, and they wrote more puts than calls. So what are the levels you're looking at? Well, the bulls, they are looking to defend the 16,000, 16,100 odd mark. Yesterday, we went down to around 16,140. And from there, we saw a bit of a bounce. So the market belief as of now is the March 2022 lows will get, will get protected. That's at around 15,700 or thereabouts. So that's going to be an important level. And I'm choosing to look at things positively. Crude is drifting towards $100 per ton. Obviously, India is a beneficiary out there. We had a 6% decline overnight. The rupee has depreciated well. Rima, Rima will tell you more about the cross currency, etc. But at least at the face of it, the markets believe that that's going to be at least, some bit of a saving grace for the IT companies. And higher interest rates, well, that should support banks, at least in the near term, because the NIMs will increase. And we already have been talking about credit growth picking up, as well as asset quality, the worst of asset quality behind us. So a few positive factors out there, 16,100, 16,150, that seems to be the buy zone. Rima, what are you looking at?
Well, 16,142, yesterday's low, so that will be crucial to track whether we breach that in today's trade. But you have to brace yourself for a lot of weakness given the global slump. And it's not just equities, even commodities. The dollar index also closed lower. So in the commodity basket, crude was down 6%, nickel was down 5.5%, gold slipped close to about 1.3%. So everything from the old economy, that is your crude and gold, to the new economy in Bitcoin. Bitcoin has plunged to its lowest level since July of 2012, and it's now down 50% from its November 2021 peak. So it's a broad-based sell-off that we had yesterday. You both spoke about flows, so just put yesterday's numbers on the board. The FI sold 3,362 crore in the cash market yesterday, while the DI has bought 3,000 crore in the cash market. In the month of April so far, the FIs have sold 16,000 crores. Talking about individual stocks, Asian Paints, Cipla, Gujarat Gas, MGL, Kansai Nerolac, these will be some of the earnings that we will track. The numbers will come out today. And the focus in terms of macros will be on the inflation print in the US tomorrow, and back home in India, the April CPI will come out on Thursday. Any signs of slowing in the price pressure will be liked by the street. So these are some cues as we navigate what looks like a tough start for our markets. But let's get you some opinion from the wise men today. Gautam Dugar of Motilal Oswal says the changing macro backdrop with heightened worries on rising rate and liquidity tightening is impacting global markets. Meanwhile, the earnings season continues to remain healthy, notwithstanding the challenges on multiple fronts. Despite the recent correction, the Nifty trades at 18.8 times FY23 estimates, near its 10-year average PE of 19.4 times. Their model portfolio positioning continues to focus on earnings visibility, economic recovery, pricing power, balance sheet strength, and reasonable valuations. They maintain their overweight stance on BFSI, IT, consumers, metals, cement, and they retain their underweight position on auto and energy.
Well, let's get you some money market calls. And Bhaskar Panda of HDFC Bank says global equity markets remained under pressure as central banks, guided for hiking interest rates to tame inflation. Now, worries about continuing Russia-Ukraine war, high oil prices, as well as supply chain disruptions, they remain. The rupee suddenly depreciated to a new low against the dollar, almost catching up with other Asian peers. Theme has not changed today, but expects some sanity to come back to the market. He's working with a range, intraday range of around 77 rupees 25 paise to around 75.55 paise for today.
And on the bonds, Bhaskar Panda says some cooling off is expected, and he sees trade within a range of 7.35 to 7.45% for the day.
Okay, those are views across